There are moments in financial history that separate the people who were watching from the people who were waiting. This is one of those moments. My name is Zara, and today I want to talk to you about something that is quietly reshaping the entire investment landscape. Something most people are either ignoring completely or chasing blindly without understanding what it actually means. Silver just crossed $75 an ounce, not gold. Silver, the metal most people think of as gold's less impressive cousin, the metal sitting in jewelry boxes and coin collections, the metal the average investor has never seriously considered. $75. And here is what makes this moment different from every other silver rally. This is not inflation fear. It is not panic buying. This move is being driven by something structural. Something built into the future of this planet the moment the world decided to go electric. A few years ago, I had a conversation with someone who had spent years building a careful, diversified portfolio. Stocks, bonds, real estate, a little gold. He was proud of it, and rightly so. But when I asked him about silver as an industrial metal, he laughed and said, "Silver is for preppers and conspiracy theorists." That conversation stayed with me, not because he was wrong to be cautious, but because he had made a mistake I have seen incredibly smart people make repeatedly. He confused familiarity with understanding. He knew silver existed, so he assumed he understood it. And because he felt he understood it, he never asked the next question, the question that changes everything. What is silver actually used for? And what happens to that demand when the world changes? Here is the answer most people never discover. Approximately 50% of all silver demand today is industrial. It is not sitting in a vault or hanging around someone's neck. It is inside products, inside technology, inside the infrastructure of modern civilization. Silver is one of the most electrically conductive materials on Earth. Nothing conducts electricity better. Not copper, not gold, silver. That single physical property makes it irreplaceable across electronics, solar panels, medical devices, and electric vehicles. When the world chose to go electric, it did not just create demand for lithium and cobalt. It created a slow, powerful surge in silver demand that is only now being fully reflected in the price. The market was late. And when the market is late, it catches up fast. Now you might be asking, if this is so obvious, why wasn't silver already at $75? That is exactly the right question, and it is the first major lesson of today. Markets chase attention. And for years, attention went to lithium, cobalt, and batteries. Silver was doing its work quietly, in the background, inside every EV on the road. Demand was building. Supply constraints were developing. And then, the price began to speak. $75 is the market finally paying attention. The real question for you is not whether you should have bought silver 3 years ago. That ship has sailed. The question is how you think clearly about what has happened, what is likely to continue, and whether any of this belongs in your own financial strategy. That requires understanding the EV demand story at a deeper level. Not headlines, the actual numbers. How much silver goes into a single car, how many cars are being built, and what that math looks like extended 5 and 10 years forward. That is exactly where we are going next. Let us talk about numbers, real numbers. Because in investing, the difference between a story and an opportunity is always found in the numbers. And when you look at the actual numbers connecting electric vehicles to silver demand, something remarkable becomes very clear. The average internal combustion engine vehicle, the kind most of us have been driving our entire lives, contains roughly half an ounce of silver. Most of that is in sensors, switches, and basic electronics. It is present, but it is modest. Now here's where it gets interesting. The average electric vehicle contains somewhere between 1 and 2 ounces of silver. Some estimates, when you factor in the battery management systems, the onboard charging infrastructure, the advanced driver assistance technology, and the high-voltage electrical architecture, push that number even higher. So we are talking about a vehicle that requires 2 to 4 times more silver than the car it is replacing. Now multiply that by scale. Global EV sales crossed 10 million units a few years ago. They are projected to reach 40 to 50 million units annually within this decade. Some forecasts go higher. When you do that multiplication, tens of millions of vehicles, each consuming significantly more silver than what came before, you are looking at an industrial demand shock that the silver market has genuinely never experienced before. This is what the phrase in today's title means: EV demand shock. It is not dramatic language. It is a straightforward description of what happens when a metal with limited supply suddenly faces a steep and sustained increase in demand from an entirely new direction. And supply is the part of this story that most people completely overlook. Silver is not like oil, where you can simply drill more wells when prices rise and expect supply to catch up within a year or two. Silver mining is slow, capital-intensive, and geographically concentrated. Most silver in the world is not even mined as a primary product. It comes out of the ground as a byproduct of mining copper, zinc, and lead. That means silver supply cannot simply respond to silver prices the way a dedicated commodity supply chain might. When demand rises faster than supply can respond, price does what price always does. It rises until demand and supply find a new balance. But there is another layer to this story that goes beyond electric vehicles entirely, and I want to make sure you understand it because it explains why this silver move may have more duration than typical commodity spikes. Solar energy. Every solar panel installed anywhere in the world contains silver. The photovoltaic cells that convert sunlight into electricity use silver paste as a conductor. As the global push toward renewable energy accelerates, and it is accelerating, driven by both environmental policy and pure economics, solar installations are growing at a pace that adds another enormous, sustained source of industrial silver demand on top of the EV story. So you have two of the most powerful secular trends of our era: the electrification of transport and the shift to renewable energy, both converging on the same metal simultaneously. That is not a coincidence. That is a structural reality built into the physics of how electricity works. Now, I want to pause here and say something important, because this is where many investors make a critical mistake. When you hear a story this compelling, the temptation is to act immediately and emotionally, to feel urgency, to feel that if you do not buy today, you will miss everything. That feeling, that urgency, is one of the most dangerous emotions in investing. It has cost ordinary people enormous sums of money throughout financial history. Compelling stories and good investments are not always the same thing. The EV and silver story is real. The industrial demand is real. The supply constraints are real. But real stories can still be priced incorrectly. They can be priced too early, too aggressively, or in ways that already reflect future demand that has not yet materialized. When silver moves from $50 to $75 in a relatively short period, some of that move reflects genuine fundamental change, and some of it reflects excitement, momentum, people buying because other people are buying. The skill, the real skill that separates long-term wealth builders from people who simply chase trends, is learning to distinguish between the two. How do you do that? You zoom out. You stop looking at the price chart for a moment, and you ask a different set of questions. Is the underlying demand story still in its early stages, or has it already played out? In the case of EV adoption, we are arguably still in the early to middle innings globally. Penetration rates in most major markets still have significant room to grow. The demand story has real runway remaining. Is the supply response likely to close the gap quickly, or will it take years? Given the nature of silver mining, the lead times, the capital requirements, the fact that most silver is a byproduct, a rapid supply response is unlikely. The gap between demand growth and supply growth may persist for an extended period. Is the current price reflecting reality or fantasy? This is the hardest question, and it requires genuine humility to answer honestly. At $75, silver is pricing in a significant portion of this story. But whether it is pricing in too much or too little depends on how the EV adoption curve actually unfolds in the real world. These are the questions a thoughtful investor asks. Not, should I buy silver today? But, do I understand what I am buying, why I am buying it, and what would have to be true for this investment to make sense over my chosen time horizon? That kind of thinking does not make for exciting headlines, but it is exactly the kind of thinking that builds real, lasting wealth. And it leads us directly into the conversation we need to have in part 3 about investment mindset, about commodity cycles, and about the specific mistakes that even intelligent people make when a powerful story meets a rising price. Because the story is only half of investing. The other half is knowing yourself. There is a question I ask every person who comes to me excited about an investment opportunity. Not what is the upside, not how much can I make. Those are the wrong first questions, and the fact that they feel like the right ones is itself a problem worth examining. The question I ask is this: what would have to go wrong for this investment to hurt you? And if it did go wrong, could you survive it? That question changes everything because it forces you to stop living inside the excitement of the opportunity and start thinking clearly about risk, about position sizing, and about your own financial reality. Let us apply that question directly to silver at $75. What could go wrong? Several things. EV adoption could slow if government subsidies are reduced, or if consumers prove slower to transition than projections suggest. Battery technology could evolve in a direction that requires less silver per vehicle. A global economic slowdown could suppress industrial demand broadly, or simply, the current price may already reflect enough of the future story that returns from here are modest even if everything goes right. None of these outcomes are predictions, they are possibilities, and a responsible investor holds both the bullish story and the bearish possibilities in their mind at the same time, not to create paralysis, but to create proportion. Proportion is everything in long-term investing. I want to tell you about a pattern I have observed repeatedly. When a commodity story becomes exciting, when it starts appearing in headlines, when the price chart is pointing sharply upward, when everyone around you seems to be talking about it, a very predictable set of mistakes begins to happen. The first mistake is concentration. People take a position that is far too large relative to their overall portfolio. They have heard the story, they believe the story, and so they bet heavily on the story. But markets do not reward belief. They reward patience, diversification, and correct sizing. A position that is too large will cause you to make emotional decisions when volatility hits, and volatility always hits. The second mistake is timeline confusion. An investor hears a 10-year structural story and then checks their portfolio every single day. They buy with a long-term thesis, but they react with a short-term nervous system. When the price pulls back 15 or 20%, which is completely normal in commodity markets, they panic and sell. They exit a correct long-term thesis because they could not tolerate short-term discomfort. This is perhaps the most common and most painful mistake in all of investing. Being right about the direction and still losing money because you could not hold through the journey. The third mistake is what I call story substitution. This is when the investment story becomes so compelling that it replaces actual analysis. You stop asking hard questions because you love the narrative. You dismiss concerns because they feel like obstacles to something you have already decided you want to believe. The EV revolution is real. Silver's role in it is real. But real stories have been used to justify overpriced assets throughout history. The story being true does not automatically mean the price is right. So how do you protect yourself from these mistakes? The first protection is position sizing. In a diversified long-term portfolio, a commodity position, any single commodity, regardless of how strong the story, should generally represent a modest allocation. Enough to participate meaningfully in upside, not enough to destabilize your financial life if the thesis takes longer to play out than expected or encounters unexpected headwinds. The second protection is time horizon clarity. Before you put a single dollar into any investment, literally write down, your time horizon and your exit criteria. Not a price target alone, a thesis checkpoint. You might say, I believe EV adoption will continue to grow and silver demand will remain structurally elevated over the next 5 to 7 years. If that thesis begins to show fundamental cracks, not price volatility, but actual fundamental deterioration, that is when I reassess. Price volatility alone is not a reason to exit a sound long-term thesis. The third protection is humility about what you do not know. Nobody knows where silver will be in 12 months. Nobody. The most sophisticated commodity analysts in the world have been wrong about silver more times than they would like to admit. The metal is famously volatile, famously susceptible to sudden shifts in industrial demand, and famously influenced by macro factors that are difficult to predict. Respecting that uncertainty is not weakness, it is wisdom. Now I want to address something that I think sits underneath all of these mistakes, something psychological rather than financial. Most people who make poor investment decisions are not unintelligent. They are not uninformed. They are emotionally activated. They are either driven by fear of missing out or by fear of losing what they have. And both of those fears, when they are running the show, produce decisions that the calmer, clearer version of you would never make. The antidote to emotional investing is not to eliminate emotion. That is impossible and honestly undesirable. Passion and conviction are important. The antidote is process. A repeatable, thoughtful process for evaluating opportunities that you commit to before the excitement begins. Ask what could go wrong. Size the position appropriately. Define your time horizon clearly. Set thesis checkpoints rather than price targets. And then, this is the hardest part, let time do its work. The EV demand story for silver is not a story that resolves in a quarter. It is not even a story that resolves in a year. It is a decade-long industrial transition that will have fits and starts, setbacks and accelerations, moments of doubt and moments of confirmation. The investors who will benefit most from this transition are not the ones who bought silver last week and are watching the price every hour. They are the ones who understood the structural story early, sized their position thoughtfully, and had the patience and psychological resilience to hold through the inevitable turbulence. That kind of investor is built through mindset, not through information alone. And that mindset is exactly what we are going to need as we zoom out even further in Part 4. To look at what this silver move is telling us about the broader direction of global capital and what that means for how you build your portfolio over the next decade. There is a concept in investing that does not get nearly enough attention. It is called a secular trend. Not a cyclical trend, not a short-term momentum play. A secular trend is a directional shift in the economy that plays out over years, sometimes decades, and reshapes entire industries and entire asset classes in the process. The electrification of the global economy is a secular trend. And when you understand that, silver at $75 stops looking like a commodity spike and starts looking like an early data point in a much longer story. Every decade or so, global capital finds a new direction, a new theme that pulls money consistently and powerfully over an extended period. In the 1980s and 90s, that theme was technology and globalization. In the 2000s, it was emerging markets and commodities. The rise of China created voracious demand for oil, copper, and iron ore. In the 2010s, it was back to technology. Digital platforms, cloud computing, mobile everything. And now, in the 2020s, the secular theme pulling capital is the physical infrastructure of the energy transition. Batteries, solar panels, charging networks, and the raw materials that make all of it possible. Silver sits directly in the path of that capital flow. But here is where most ordinary investors make a costly error. They wait for confirmation before they act. And by the time confirmation is visible and undeniable, by the time silver is at $75 with headlines everywhere, the easy gains have already been made. The people who positioned themselves thoughtfully when silver was at $25 were not lucky. They were early. They were reading the same structural story before it became consensus, before it became comfortable, before it became obvious. I am not telling you this to make you feel you have missed the boat. I am telling you this because the lesson applies forward, not just backward. There are secular trends unfolding right now that are still in their early stages, still uncomfortable, still being dismissed by smart people. The question a forward-looking investor asks is not just what is already moving, but what is the next thing that will move, and why? That requires developing structural vision, the ability to look at large-scale changes in technology, energy, and demographics, and trace their implications forward to specific assets and commodities before the crowd arrives. Silver and the EV revolution is one chapter in a very long book. The investors who build genuine, lasting wealth are not the ones who found one magical opportunity. They are the ones who developed a repeatable framework for identifying structural change early, positioning with discipline, and staying out of their own way long enough for the thesis to play out. That framework, not any single trade, is the real asset. I want to start this final part with complete honesty. Everything we have discussed today is real. The industrial demand is real. The EV connection is real. The supply constraints are real. The secular trend is real. And none of it guarantees you will make money. In the excitement of a major price move, silver at $75, headlines everywhere, everyone suddenly talking about the same story, that simple truth gets buried under enthusiasm and urgency. So here is my warning. Hear it clearly. The most dangerous investor in the room right now is not the person who knows nothing about silver. It is the person who just learned everything about silver and now feels certain. Certainty is the enemy of good investing. The moment you feel truly, deeply certain about any investment, that is the moment to slow down and apply your most rigorous skepticism. Certainty closes your mind to new information. It makes you dismiss warning signs as noise. It makes you hold too long when the thesis changes. Silver has been here before. In 1980, silver reached nearly $50 an ounce, driven by inflation fears and concentrated buying. Then it collapsed, spectacularly. It spent the next 3 decades at a fraction of that peak. The people who bought at the top, certain they were riding an unstoppable trend, waited decades just to break even. I am not saying silver will collapse from $75. I am saying history does not reward certainty. It rewards preparation, patience, and intellectual humility. If you have genuinely assessed your financial situation, understood the demand dynamics, and decided some exposure to this theme makes sense, then act with proportion. Size your position so that a significant decline would be uncomfortable, but not devastating. Define your time horizon before putting a single dollar to work, and commit to the process rather than the outcome. Because here is the deepest truth I know about long-term investing. You cannot control outcomes. You can only control process. You cannot control where silver goes next month. You cannot control EV adoption rates or global economic conditions. None of that is in your hands. What is in your hands is how you think, how you size, how you diversify, how patiently you allow a well-researched thesis to develop. That is your process. And a sound process, applied consistently across multiple market cycles, is what actually builds wealth. Not one perfect trade, not one perfectly timed commodity call. The silver story and the EV demand shock are one opportunity within a lifetime of opportunities. Treat it that way. Engage with it thoughtfully, proportionally, and without emotional attachment. The investors who build real, lasting wealth share one quality above all others. It is not intelligence. It is not access to information. It is the ability to remain calm and clear-headed when everyone around them is either panicking or celebrating. Calm, clear, consistent. That is not a personality type. That is a skill built through practice and through the conscious decision to think before you act every single time. You came here today because a headline caught your attention, but what you leave with, I hope, is something far more valuable than a hot tip or a price target. You leave with a framework, a way of seeing opportunities that goes beneath the surface, asks harder questions, and respects both the opportunity and the risk simultaneously. This is Zara. Stay patient. Stay curious. Stay clear. The market rewards the prepared mind, not the excited one.